welcome back. Let's get into some actual accounting here. So we have the anatomy of a transaction. I'm going to go over debits and credits with you, and this is pretty much day one stuff. You've got to learn credit and debit theory and why it applies to accounting. Now, I know QuickBooks and everything does it for you, but you still have to know why it's doing it. Because if you ever run across a problem and somebody asks you, well, why this and why that, I don't know. Well, you should have learned your debit credit theory. So let's get into it. First, I want to talk about the accounting equation. So assets equals liability plus owner's equity. Now, this can be written different. This can be owner's equity equals assets minus liability. Most business schools are going to show it this way. So just drill that into your head. Try to remember it however you need to remember it. Look it up on Google. But just remember that that's the accounting equation. And let's move on to debits. Now, debits and credits, as I said, are important. They're theory, they're day one. You have your bank account, Wells Fargo Bank, whoever, and you have your statement. And let's say you have $1,000 in the bank. Now, it's usually an expense account. So what's going to happen is every time you debit, you're taking money out of the account. Every time you credit, you're putting money in. So let's say you got a payroll check. That's a credit to your account for X amount of dollars. You buy food and maybe some gas to put in the car and other things. That's going to be a debit to your account. It's going out. Now in accounting, it's a little bit different in the theory side. So an asset increasing is a debit. A liability decreasing is a debit. So an asset. So if you get cash as in revenue, if you get revenue into the business, that's cash, and that cash is an asset. Now, increase. Now, a liability decreasing, so let's say you paid a bill, a liability decreasing, that would be a debit also. And we're going to get a little more into this. I got a song for you. Credit and equity. So a liability increasing is a credit. You bought something with your credit card, you increase the credit in the business. An asset decreasing is also a credit. So money going out or money going somewhere else. And we're going to look at an example of that. This video is really cheesy. It's an accounting rap song. It was shown to me in business school on like my first day. So I'm going to run through it. Hopefully you can hear the video. If not, I'll link it to the link to the YouTube video in the course description. This almost never happens in business anyway. Nobody just stands there and looks at things and nods. Yeah. You could tell this is the guy that's like done with his job. Or he has nothing to do, he's just making rap songs. So you see some of the things I was talking about that he explains in the video. An asset increasing is a debit, liability decreasing is a credit. So also assets and liabilities are not good or bad. Some people look at that, don't look at it that way. They're transactions. They're not like good and evil. They're not pitted against each other. They're just how transactions work. So please get that out of your head if you have it in there. All right. Now, something I learned from a CPA, DC Adler, and this really helped. Now on the debit and credit side. Now this isn't a full description of each account that's going to be debit and credit, but usually this is these are kind of fixed. This is the typical transaction that's going to happen to these accounts. So assets always going to be a debit. Draw is almost always going to be a debit. Expense is almost always going to be a debit. Liabilities will always be a credit. Equity will always be a credit. Revenue will always be a credit. Now, don't limit yourself to that, and don't limit to just this list. I mean, there's lots of ways transactions can happen, but this is typical. This is pretty much fixed. So let me show you a transaction. Now, invested cash. So, Bob took $100,000 from his personal savings and invested into a consulting business he wanted to start. So he put $100,000 into the business. That's an asset. That $100,000 is now an asset. Now it goes to a credit because that $100,000 can't just sit there. It's got to go somewhere. And it goes into his equity. So he has $100,000 in equity. Now look how they equal out. Balance the transaction. We have a debit and a credit. This is double entry. Debit and credit. And it both equals 100. It's not 100,000 here and 150,000 there. It's 100,000 each way. So, and we're going to look at this. We're actually going to use this in the future to look at how money flows through a business. But in a basic sense, this is debit, credit. It goes in here. It's got to go somewhere, so he puts it into equity. It sits in equity. He hasn't used any of it yet, so it totals out to $100,000. It's always going to equal. So I hope you enjoyed this. I'm going to get into this a little bit more. You're going to see how transactions work throughout the business. It's going to be insane. So just stick with me. Thanks for watching.